Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Tuesday, the 1st of November. I'm Daniel Lam, your host for the podcast. Today is my first day back at the office after my block leave, and I must thank Steve for covering during the last 2 weeks. I was in Malta competing at the World Amateurs Chess Championship. The opponents were much tougher than I was expecting. For example, back in 2016 and 2017, my games at the championship lasted for roughly 35 moves on average. Fast forward to this year, they were lasting for 60 moves. And of course, nowadays, I'm frequently facing opponents 1/3 or half my age. So clearly, the winds were changing this time around. In investing, we must all adjust our expectations or approaches depending upon market conditions. I remember a few years ago how our Global Investment Committee was desperately searching for ways to enhance investment yields for clients. And we even wrote a think piece about how to apply leverage in order to enhance the risk and reward on fixed income investments. Now fast forward to this year, there is much less need for such leverage strategy, as bond yields are firmly back to their pre-2008 range. We see today's yield in high-quality bonds around 5.5% on DMIG corporate bonds, over 7% on multi-asset income strategies, and over 8% on Asian dollar bonds. These are attractive opportunities. Now, of course, bond market volatility remains unusually high. There has been, for example, a 70 bips move in the US 10-year yield from the intraday low to high in October. This remains a key headwind for income asset classes for now, given high yields mean lower bond prices. It's quite tempting to wait out bond market volatility in the safety of asset classes such as cash, where yields are also no longer zero. However, while we do see a place for cash in asset allocations today, we would not allow this to hold us back from adding to high-quality income assets, on a few reasons. First of all, price volatility is visible upfront, but the yield is collected after staying invested for 12 months. Secondly, the higher yield means it forms a larger component of 12-month returns, which also helps to reduce the sensitivity of bonds returns to changes in government bond yields. And lastly, adding exposure today well into a Fed hiking cycle lowers reinvestment risk, i.e. the risk that bond yields are much lower in a year's time or longer, potentially forcing investors to accept lower income at that point. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.